Silver, even though it's a smaller market, becomes a beach ball effect factor due to just how fundamentally undervalued it is.
Quite a few topics here that are massive. I'm in awe just listening to what's happening in the background here in terms of these movements. Maybe you can just go a little bit further into this topic here.
Okay, Shane, absolutely, and this is game-changing stuff. I mean, it's going to change this paper to physical balance. This is actually it's manna from heaven, and obviously, look, we're not taking sides here. Obviously, we realize the sanctions, why they were imposed, etc. It's just the nature of how they were imposed, and that's really backfiring. And so I'm going to give you some updates as what we're hearing of the phasing in of this resulting drive to create this BRICS currency basket. So in our last episode, we looked closer at a reliably sourced makeup of this basket, and we'll report more on this over the next few weeks. But notably, the total under the radar of this is completely under the radar of the specs trading in the COMEX, the dot on the screen in the COMEX, is how the tiny ring fence silver market component of the commodity basket reacts to a real physical demand explosion. So silver, even though it's a smaller market, becomes a beach ball effect factor due to just how fundamentally undervalued it is, and how the physical price being discovered outside the LBMA CME ring fence is going to blow this linked position that is transparent on the Office of the Comptroller position that links directly to the SLV. And that is a scam. It's going to blow that scam wide open. And while the likes of JP Morgan and the other market-making banks race to exit, providing liquidity to these base metal space, the over-the-counter, because of the over-the-counter nickel explosion, nearly caused a default. If they hadn't been bailed out, that would have caused a default of a too big to fail bank. Now, we've got reliable first-tier feedback that JP Morgan are also racing to call in their leveraged silver leases, which is what we just discussed a minute ago. It is the double down COMEX specs that are headed for the religious experience. So, and JP Morgan, of course, is going to slip out like a bar of soap, and really that's why they're scrambling to get their silver back. Now, this week, we'll expand a little more on this as timelines for a physical pushback against paper prices really look to be ramping up exponentially. And the over-the-counter derivative structure currently enveloping all recently driven upside price breakouts in gold and silver is very close to imploding and going nickel. Now, this brings us on to the China factor. The building friction over Taiwan notably escalated following China issuing the US a red line not to cross. We kind of touched on this last time, but the serious warning follows on the heel of the US ignoring Russia's red line warning regarding the NATO expansion into the Russian borders, which, given the unfolding footprints, in retrospect was by design a long-planned US proxy war against Russia, safely contained inside the siloed US-Ukraine regime. Now, just to be clear, please, I have to say this, I'm not taking sides, merely digging a little beneath the official narrative to realize this conflict is going to escalate, conveniently dragging Europe down to the advantage of the US, and how this affects gold supply and demand fundamentals. That's really what we're looking at. And it just cannot be ignored that the ill-conceived Russian sanction blowbacks are having a 10 times larger impact on Europe. And if Russian sanctions are not wound back, which is not likely, it virtually assures a European recession. This inequitable blowback is so blatant that one must question if it is not convenient and not a convenient part of the US plan to weaken the globally competing Eurozone. Eurozone was always a thorn in the side of the US dollar. So nevertheless, this, be that as it may, this recessionary tail will feed back into the US at the very point when the Fed has lost control. China will clearly factor in these vulnerabilities into their decision-making process, but one thing is clear: the resulting US dollar hegemony blowbacks were not anticipated at all by the West. And while a proxy war against China following an incursion into Taiwan is currently off the table, and the US military complex knows ignoring China's red line risks a third world war, we see China acting proactively. And if there was a window for China to pull the trigger on Taiwan, it will be while a weakened US is at its most vulnerable, possibly, as we said, before the midterms, which could ultimately flip the pendulum into a military aggressive Republican Trump regime. So obviously, at this point here, they're dealing with, the exit from Afghanistan. They're dealing with a very woke US military. A Trump regime or Republican regime may not be as easy to actually counter. So really, I'm just giving you the process. This is what when we speak to our liquidity providers, these are very, very well-connected people who are saying, this is the kind of the thoughts that they're picking up on. And while COMEX-centric traders are completely blinkered to the escalating geopolitics, this has become a major driver for sovereigns and central banks to purchase physical gold. China is anticipating being sanctioned, and the first step is to ready for an upcoming conflict, is for China to ramp up their already active de-dollarizing process and accelerate the establishment of this BRICS currency basket. And if that was not enough, the single mainstream media narrative continues to ignore the elephant in the room, which is namely Russia gaining a missile base foothold in Nicaragua, enabling Russian missiles from the south to target every city in the US, which we've assessed last time seriously ramps up